Okay, and welcome to those that are watching the DVD as well. We're going to go through audit compliance. And as Morris said, my name is Leantha Naidu, so you can call me Lee for short. Okay, that's my email address as well as my details. For the guys that are watching on the tapes, if you have any audit-related questions, you're welcome to email. Just a quick agenda of all the things that we're going through today. It's listed on the slide, and I'm going to be giving you practical examples as we go along as well. As Morris said, I would much appreciate if you jot down your questions and then ask them later on regarding audit compliance. I'm going to be joined by Thomas, who's the Audit Compliance Officer of the State Agency Board as well, so if you have any questions for him, you may ask. Okay, maintaining of the trust accounts. We're going to talk about that. What does that entail? And how do we relate that to our audit? Maintaining of the business accounts. Again, how do we relate that to the audit? How do we actually maintain the business accounts? What do we need to do? Preparing for the audit, the much dreaded audit. Okay, what are the things that we need to get in order? What are the documents that we need? What are the things that the auditors are going to do? And what's our deadline? Okay, now that you've had the audit, what are the different sections within the act that governs you? What are the different sections that we need to look at? As well as implications of the audit report. So you've done an audit, and now you've got an audit opinion, okay? What did the different opinions mean? What are the different opinions that you could get? And also, what are the repercussions of the different opinions and the legal responsibilities, as well as the submission? So who's responsible for submitting this audit report from the auditors? When does it need to be submitted? And what happens if you don't submit it? All right, so that's our agenda today, and those are the things that we're going to talk about. So I'm going to dive straight into it. Section 29A of your Act, which is the Estate Agents Affairs Act, requires for all accounting records to be audited. So, what constitutes as accounting records? These will constitute your assets, liabilities, income, expenses, owner's equity, debtors, creditors, memorandum of incorporation, shareholders agreement, loan agreements, fixed asset registers, anything that you require to account for in your business, any legal document or any book of accounting or invoice, all of that is regarded as accounting information. So the Act requires that stuff to be audited, all right? They also say that the trust account and the business account needs to be kept separately. Now, what does that mean? It doesn't mean that you need to keep both books in a different room. It means that you need to have two different accounting record systems. So if you're using Sage, Pastel, or if you're using manual books, it means that both need to be kept separately. In most instances, the transactions between a trust and a business interlink, am I right? So what they're saying is they want to see if the debits in the trust account and the credits in the business account, they want to see it kept separately. They don't want you to have one set of books with everything in there, all right? So two separate. They need to be audited separately. That's what the Act is saying. Now, a question that comes up often, can we have the same auditor auditing our trust account and the business account, or can we have separate auditors? Well, let me tell you how auditors are paid, all right? We're charged a rate times time. So if I work for you at 500 Rand for an hour, then it's going to be 500 Rand times 8 hours in the day. So if you're having two different auditors, one for your business and one for your trust, at some point, I'm going to have to rely, if I'm auditing your business accounts, I'm going to have to rely on the auditor that's doing the trust account. So in my world as an auditor, I need to be able to perform work on that auditor to make sure that he's reliable, he's independent, he's been accurate, free from any biasness. So that's going to take more time, okay? So the more time I take testing that auditor, guess who's paying for that? I think everybody wants a reasonable audit fee. Nobody wants to be paying more than they should. So in order for you to have an effective audit, I would suggest the same auditor for both. But if you have the resources and you'd like to have two different auditors, that's entirely up to you. And then I've got a little excerpt there from the Act, which says, every estate agent shall open and keep one or more separate trust accounts, which shall contain a reference to the section with the bank. So when you go to a bank and you're saying, I'd like to open an account with you, you designate the fact that it's a trust account at the bank. So the bank knows that this trust account is governed by the Estate Agency Act. So that's the reason why when you go to the bank to open a trust account, you just don't say, I'm here to open up a bank account. You say what it's for, and chances are the way that the bank account is structured, your bank charges are going to be different from a normal bank account. Please note, if this bank account at the bank, the trust account, is closed at any stage, you're obviously not allowed to transact and be an estate agency if this account is closed. And the Act also says that the bank trust account needs to be reconciled monthly with your trust creditors ledger. Layman's terms, the amount at the bank needs to tally up or reconcile to the amount in your books. Okay. So the auditor is going to come in, and he or she's going to have a look at your accounting records, and they're going to say, okay, where is the recon? I want to see the recon. I don't want to see the trust bank statements. I don't want to see your books. I just want to see the recon. And this recon needs to be performed on a monthly basis. So if you do not do it on a monthly basis, let's just say, okay, there was load shedding, computer switched off, I'll do it, I'll catch up next month, right? You'll have to log on and say what time it was. Okay, you did it after a month, and now you're catching up. The Act specifically says that the reconciliation process needs to happen monthly. And if the auditor picks up that it was not done monthly, it results in something that's called a reportable irregularity, something that we need to report. But we'll get to that at a later stage and what that entails and what it means. But I just want to explain to you how important it is for you to actually do a reconciliation every month of these two balances. So let's look at the term reconciliation. It's the reconciliation in accounting terms. It basically says that something has to reconcile to something. And those two somethings are the trust bank account, your trust account at the bank, and your trust creditors ledger. Now, let's just look at interest-bearing funds for a second, okay? So per section 32.2, it says, any estate agent may invest in a separate savings or other interest-bearing account opened by him with any bank, and it needs to have a reference to this section. It's very important for you to note that you have a choice between a savings or an interest-bearing account. Most people think that it's just interest-bearing. No, it's not. You have a choice. If you want to put it in a savings account, as long as you stipulate with the bank what the savings account is for and what it represents. And you need to obviously have a mandate with the client that says, okay, I've put your money in a savings account, I've put your money in an interest-bearing account. When you submit your audit report, okay, the board, the Estate Agency Affairs Board, requires the auditor to stipulate on the actual audit report what money did the estate agency collect in terms of interest-bearing funds, and what is the portion that was calculated that is due to the estate agency. So it's very, very important for you to keep accurate records if you choose the interest-bearing account way. Back to the reconciliation. When the auditor comes in, like I said, they're going to request that monthly recon from you. And what I've put up on the slide for you is the things that they are going to be doing to the reconciliation. Remember what I said, how an auditor is built, time and money. So the longer they spend on this recon, the more they're going to charge you. So my advice to you is to be able to do this yourself so that when they come through, it's actually 100% already. They don't need to request things from you. They don't need to now recalculate your recon. They don't need to spend too much of time with it because you've done it and you know the procedures that they're going to perform on it, and you've done it already. You've done the recon monthly. You know how to do these audit procedures that I have listed on this current slide. And when they come in, they're going to spend 5 minutes on it. They're going to request a few things from you, maybe a few bank statements or a few check numbers or documents or journals. Other than that, it's going to be fine because you've audited it already. All right? So the audit procedures that I have up on the slide right now is what the audit is going to do. So when you take your recon at the end of 12 months, you need to see that it was done monthly by yourself or by your accountant. All right? You need to confirm the opening and closing balances of the trust account and the trust general ledger by inspection. So what is that saying? That's saying that your opening balance of your reconciliation needs to have come from last month's or last year's, all right? And you need to see that the closing balance was taken to the next month. That's how a recon works. The opening balances are pulling through from something prior in the prior year or the prior month, and then your closing balance is carried forward to the next month or the next financial year. Makes sense, right? And then, have you verified those opening and closing balances? If you're taking it from the bank account, make sure, the trust account, sorry. If you're taking it from the trust account, make sure that it matches the bank statement. Now, sometimes it happens that your books that you have, your accounting records that you have, don't meet the accounting records that are within the trust account. Now, how does that happen? You all heard this term, 3 to 4 working days. Your check will come into your account or will go through, pull through after 2 or 3 working days. Now, we've all heard that term. It's quite annoying. I mean, you get paid today, but you'll only get your physical money tomorrow because that's how much time it takes to clear in the bank. It's just the way the banking systems work. So sometimes you have deposits that you've accounted for in your books. So you've done a sale, and you've got all the records, and you account for it in your books. But now it's public holiday, it's Women's Day, and the money hasn't reflected on the bank just yet. So when you're doing your month-end recon, you account for this, and you say, okay, it's going to appear in the bank account in 2 days. So you account for that in your recon to say that it's an outstanding deposit or it's a deposit in transit. So you note it on your recon, and the next month it would have cleared. Then you've got something called outstanding checks, where something appears in the bank side, but because it was Women's Day and you took the day off, you didn't really get around to doing the recon, or you didn't really get around to accounting for it. So then you account for it in your recon to say that money was received but accounted for a bit late. As long as you know how to work this recon, because these are the things that the auditor is going to be looking for. So don't let your accountant bridge the gap with the auditor. You as a business owner, you as a principal need to understand these processes as well. Okay, because I mean, when you're being asked a question by the auditor, surely you want to be able to give an answer of what happened in the recon rather than saying, hey, speak to the accountant, he knows what's going on. All right? Then you get something like bank charges. So for example, if your recon is off by 58 Rand or 62 Rand, chances are it's your bank charges. Okay, and then, like I said, make sure that your closing trust account balance matches your trust account, which is the bank. This is an example of a simple recon. As you can see, you've got a balance per your trust account at the bank. You've got things that you add, things that you subtract, and you have a closing balance. So these things need to be balanced monthly. So the bank balance needs to match your books monthly. Now, there's information that needs to be found within your trust creditors ledger. Firstly, before I get into the information, why does it need to be there? Has anybody ever heard of that term, debtors or creditor circularization? What the auditor does is, as you know, they rely on independent information. That's why we're independent. It's not because we don't believe what you say or we don't take for granted what you tell us. We're appointed because of the fact that we are independent. So if you give us a creditors or a debtors listing or a trust creditors ledger, and if we want to confirm a balance of 10 million, okay, that's quite a big amount. Yes, we've confirmed it with you. What's the next step? We need to find out from the debtor or the creditor ourselves for our own personal records. That's what's called a debtors or a creditor circularization, where the auditor directly goes to your client or your creditor or your debtor and says, can you confirm the balance? We won't give them the balance. We'll say to them, you confirm the balance that this estate agency either owes you or you owe them. All right? And then if they don't say 10 million, then that's a problem. So we need your client's details in the trust creditors ledger specifically that's one of the reasons. The board also requires it because it's just a standard way for them to make sure that you're running your business in an approved manner, okay? So the information that needs to also be found in your trust creditors ledger, which you need to inspect and make sure is there. If your accountant is doing your books, make sure that they've included all of this information. The name and the address of every client that's listed on this trust creditors ledger. The names of other parties that are involved in a transaction. As you know, sometimes it's never just to yourself and a buyer. It's always other parties that may be involved. The date of each transaction, because we need to see which financial year does this transaction actually fall in. Is it this year? Is it next year? All right? The names of the persons whom money was received or whom was paid to, so obviously we can contact them. the reasons for the movement of money, the amount, and something that we can track, a document number, an invoice number, a journal number, receipt number, or check number, something like that for the auditor to be able to track. And then the balance after each entry in your trust creditors ledger. What is the board ultimately trying to do? It's a trust creditors ledger. Do you have enough money to pay your trusts? After each entry, they want to see a balance to make sure that you are not in a deficit. So this is what your trust recon, your trust creditors recon needs to look like on a monthly basis. As you can see, it says January, February, March. That should go for your whole year. So if your financial year starts in June, then you need to have June to June. All right? If it starts in February, you need to have it from Feb to Feb. So monthly for the year. And then you've got the total of trust creditors as at month end. Okay. This is the amount per your records, your accounting records. And then the reconciled trust account balance. Okay. This is the bank balance. The trust account at the bank. Okay. It needs to be the same. You can't have a difference of 10 Rand or a difference of 5,000 Rand. If you have a difference of 5 cents or 2 cents or 10 Rand, okay, it's probably because somewhere along the line, the amounts that you added or subtracted were incorrect. The auditor will the auditor will definitely let that pass because it's probably an error on accounting. So instead of saying 1 plus 2, you said 1 plus 3, something like that, okay? But if it's a deficit, it's a more serious matter because it means that you as a business owner does not have enough money in the trust accounts to pay all trust creditors. So that's a warning sign for the board as well as your auditors. Okay, so a surplus, yes, I'll accept it. 10 Rand, 5 Rand, even 100 Rand, up to 100 Rand. It's just a mathematical accuracy. I'm not saying that you need to leave it at that difference. You need to go and fix it so that it equals out. But that's slightly easier to fix rather than not having enough money to pay trust creditors. Maintaining of the business accounts. Now, as you all know, you've got a trust account on one side, and then some of you may have a company, a partnership, a CC if that still exists for you, or a sole proprietor. Now, what the Act is saying that as a business owner, we've dealt with the trust. Now as a business owner, your business needs to go under scrutiny. Your business needs to be audited, okay? Like I said, assets, liabilities, income, expenses, owner's equity, share capital, memorandum of incorporation, fixed asset register, tea and coffee statements, shareholders agreements, loan agreements, leases, you name it, needs to be audited. Now, I'm not saying that the audit is going to come and ask you for all of that. It just depends on the scope of the audit. For example, if they've been your auditors for 3 years, they'll probably only ask you for the lease of your building, your business building, in the first year, unless the lease has changed, etc. But they're not going to ask you for the same thing over and over again. A good auditor will be your auditor for 5 years, and then the partner on the auditor will change, and then you'll have a new team there. If you want to stay with the same company, that's up to you. So they won't ask you for the same thing over and over again. So what I'm going to show you now in the next topic that we're doing is how do you become audit compliant? How do you get ready for the audit? How do you make sure that everything's up to date before the auditor gets there? Just a quick section on Companies Act says that any documents, accounts, books, writing records, or other information that a company is required to keep in terms of this Act needs to be kept for a period of 7 years or longer if specified. You've got to keep records for at least 7 years. I was an audit manager on Transnet, okay? Can you imagine the documents that they keep for 7 years? They have rooms the size of this room. That's a filing room or bigger, okay? So if you're a smaller business, like an estate agency, you can keep them on a soft copy, meaning you can scan them and put them on your system and then make a backup of that every so often so that your documents are all good. But if you're keeping them manually, then I would say safeguard those documents because at some point, the auditor is going to request something, and if it doesn't exist or it's lost or it's burnt down or something like that, it's a limitation of scope. Now, what does that mean? It means that because I couldn't get a document that I needed for the audit, I'm limited in my scope of audit. So I cannot give comment on this area of audit. It could quite possibly affect your audit opinion at the end of the audit, and nobody wants that. Nobody wants that. You shouldn't have that. That's no excuse to get a qualified audit opinion because you were missing a document, an invoice, a transaction, a bank statement. That's no excuse. If you fall like that, it's not worth it. So my advice, keep your record so that when the auditor asks for something, you are compliant and you have it. You've got a soft copy, you've got a hard copy. All right, great. So it's important for you to note that your auditor needs to audit your financial statements, okay? Verify, they need to test those financial statements. It's important for you that, okay, let me ask you a question before I make that point. Can your bookkeeper audit your financial statements? The answer is no, okay, because your bookkeeper is not independent. Your bookkeeper is not affiliated with IRBA, the Independent Regulatory Board of Auditors. Can the auditor prepare the financial statements? If your auditor is preparing your financial statements, he or she needs to be fired because your auditor cannot compile your financial statements. Your auditor needs to be independent. If they are auditing a set of financials that they have prepared, it's called a self-review threat. They are reviewing themselves, they're auditing themselves. And it accounts to a disciplinary violation in terms of our ethics and codes of conduct with SICA and IRBA and Audit Profession Act, and they need to be reported. So please don't let your auditor prepare the financials as well as audit it, okay? If they say that they're capable of doing that for a good fee, please, you're gonna get into trouble. Do not let them prepare your financials. It should be your accountant with the BCom degree. Okay, not the auditor who's probably the CASA or the person that's going to sign off the audit report. So like I said, it's the auditor's job to audit a set of financials that you've already given them. It's their responsibility to go in and say, okay, you've already got the statement of financial position and the statement of comprehensive income, which is the old balance sheet and income statement. It's now called the statement of financial position and the statement of comprehensive income. The names have all changed, all right? So you've already given them the financials with the notes, with the policies. They just need to audit, all right? It's not prepared by them. Please note that. You know, and I don't mean any offense to this, but it's often in the smaller provinces or the smaller towns where auditors or accountants say, you know what, I can audit this, or the auditor says, you know what, it's just a small thing, I'll prepare the financials for you. They're not allowed to. It's not their job to do that. How many of you have seen this equation before? So why I'm showing you this equation is because when your auditor comes through and they ask you a question on a transaction that occurred in your business, you're like, oh no, please speak to the accountant. I don't know accounting. I never did it in high school. I never studied it. I did sales and marketing. The reason why I'm showing you this equation is so that when the auditor does come and ask you that question, you are equipped with the accounting knowledge to be able to answer the auditor. So if you have a transaction, you're going to have two things in that transaction. You're going to have a debit and you're going to have a credit. Now, what's debited and what's credited? It'll be the accounts that come from your income statement and your balance sheet. A is equal to OE plus L. Assets is equal to owner's equity plus liabilities. So I'm not going to say the new name. Let's say balance sheet for now, right? You know, when you look in your balance sheet, the top of the balance sheet equals the bottom of the balance sheet. So the top of the balance sheet is all your assets, current and non-current. And the bottom of your balance sheet is your owner's equity, owner's loans, liabilities, short-term as well as long-term. So what the equation is saying that in your business, all your assets need to be equal to your owner's equity and your liabilities in accounting terms. I'm not talking about if you're over-geared or if you're over your liabilities measurement, you've taken more loans out that you should have, even if you did, okay? Your assets need to be equal to your owner's equity plus your liabilities. Now, whenever you get a transaction, think of it in these three components. Is it an asset, is it an owner's equity, or is it a liability in terms of your balance sheet? Okay? Now if we bring in the income statement, you've got two other components, income and expenses. Okay? But for the balance sheet equation, this is what you need to know. Now when we bring in the income statements, I've put up something called a T account. Okay. What is a T account? It's an account that helps us to understand transactions. So for each component, you've got a T account. You've got an asset, a liability, expense, and owner's equity, as well as income. So you see there on some of them, they have a balance with a few X's, which stand for amounts on the left-hand side. And for some of them, they have a balance with a few X amounts, which stand for an amount on the right-hand side. So in accounting, this is the law. These are the rules. An asset will always increase on the left-hand side, which is the debit side. That's why I've put the word balance there for you. All right? A liability will always increase on the credit side, which is the right-hand side, which is why the balance is written on the right-hand side. Okay? Same goes for expenses. If you note something by now, an asset and an expense is the only T account which increases on the right-hand side, which is the debit, and the rest are all credit. So if you have a contract, whatever the transaction may be, even if you're buying groceries or for the business, or you're buying property, if you're putting money from a sub-leasee to the bank account, whatever the transaction may be, even your tax expenses, try and break it down into a T account. Try and break it down into its debits and its credits, and it will become so simple. So let's look at an example. You are the sub-leasee of a house in Zimbabwe in Durban, right? Okay, we all live in Durban now. You've received 10,000 Rand for the month of August, right? Now, it's 10,000 Rand for 2 days. You've received it at the end of August. So for you as an account holder, as a business owner, what are the debits and the credits? What's going up? It's an asset. Your bank account is an asset, so it's debit bank with 10,000 Rand at the end of August, right? What's being credited? Let's forget that you need to pay over the money and deduct your fee as a letting agent, blah, blah, blah. Let's just say that we're crediting the full amount into your bank account. You credit your income, sub-lessee income or something to that effect, some type of income, right? Now that you've done that, you now need to pay at the end of the financial year the total amount of rentals that you had for this beautiful home in Zimbabwe to the owner, minus all your fees that you've charged him for the year, right? So let's say you've collected 100,000 Rand just by renting or leasing this place. Your fees of that is 50%. How awesome is that, right? So you get 50,000 Rand to keep, which you've already banked during the year. Now you need to pay over 50,000 Rand at the end of the year, which is December. So what do you debit? Expenses, excellent, right? So your expense, as you see, is being debited on the right-hand side, on the left-hand side. And then what do you credit? A liability, exactly. Because this is somebody that you owe money. It's sort of a creditor. Actually, it is a creditor, somebody that you owe money to, okay? So your liability goes up by 50,000. That's how you use the T accounts. So this is your work of art that you need to print and put it up wherever you are so that you understand how these T accounts work. Any transaction, anything, the accountant can give you anything. It will always be broken down like the way I've just shown you. There's in no country, not even Canada or Ireland, where the debit is on the right-hand side. We use something called International Financial Reporting Standards. There's over 90 countries that do the same thing, okay? So if you go to Scotland and you're trying to account for the transaction, it will be the same way that you're doing it right now, because it's international. This is the international form of business. The debits and the credits work the same almost everywhere you go. So let's look back at our example of the 10,000 Rand from Zimbabwe in August. Now, our financial year end was at July, the 31st of July. And this person who rented the home, he signed the contract at the end of July, 30th of July, he signed the contract. But he only paid us in August because, you know, when people book homes in Zimbabwe, it's like just an administrative function that they need to pay over the amount. And you know, okay, if they're booking a house there, they've done all the paperwork, chances are they are going to probably pay you. It's a repeat customer, and you know that they're not very good at admin, and you're not too stressed about the amount. What happens in your books, in your records, in your accounting records, as at the 31st of July, which is also your financial year end. What do you do with that 10,000 rand? Remember, you've signed the deal, you've signed the lessor contract, he sent through all the paperwork, his proof of income, his the back and the front of his credit card to say that if there's any damages, you can deduct from my account. He's listed references, he's a repeat customer, but he hasn't paid you. So when do you account for that 10,000 rand? As a provision. Okay, it's money that's due to you, right? So you cannot account for provision of loss of income, right? Because it is income at this stage. But do you account for it as income? Maybe I should ask you that. Do you account for it as income in the July year end, or which is 2015, or do you account for it in August, which is the 2016 year end? In July. The accrual basis of accounting says that it's an accounting method that measures the performance and position of a business by recognizing economic events regardless of when cash was transferred. Economic events means signing of a contract, okay? Building of a house, an agreement. But now, if it was verbally agreed, it just depends if it was constructive and he led you to believe that it is an agreement. But nobody ever does that, right? Nobody ever goes by a handshake anymore. It's always a signed contract, which was done in July. Therefore, this 10,000 rand will be accounted for in 2015, July 2015, even though you didn't receive the amount of money yet. Okay, so we needed a standard across the board. That's why we have something called the accrual basis. The cash basis was something that was used during GARP days. I'm sure you all remember GARP days, just like I do, right? So we needed a standard across the board. How do we account for situations like this throughout the world? Then that's how the accrual basis came about, okay? We look at economic events rather than when the money was actually transferred, and everybody does this, so it's cool, right? We're not deferring from any other method. Now, the opposite of that, which I mentioned earlier, was the cash basis, which is GARP, which we did in the old days, where the 10,000 rand would be accounted for in 2016, because that's when we received the money, okay? And the reason why we don't do this anymore is because think of it this way. We can sign 20,000 contracts at the end of July, only to be accounted for in 2016. And it was found that business owners tend to overstate their profits by doing this, okay? So you're taking all your money that you're supposed to earn in 2015 to put it in 2016, maybe because you have a deferred tax asset that you want to use up, something like that. So in order for us to be straight and narrow and to the point, we need to use the accrual basis. So who is an external independent auditor and what do they do? Sometimes you may hear people referring to external auditors, independent auditors, something like that. That's generally what we're called. And it's somebody that's registered with IRBA. What does IRBA stand for? The Independent Regulatory Board of Auditors. And we are there to examine the financial records and business transactions of a company that he or she is not affiliated to. That is the big thing, okay? That is the jackpot right there. We cannot be affiliated to your company no matter what. So if your wife or your husband has an auditing company, can that auditing company audit you as an estate agency? The answer is yes. But that spouse cannot be anywhere near the audit at all. If the relationship is so close, say for example, it's a really small audit fee and your spouse is the only audit partner in that business, then the answer is no. But if you've taken on PwC and PwC has over 30,000 partners and your spouse is based in Dubai, of course you can be audited, right? Chances are they're not going to affect the opinion of your account. But if your spouse or your child or your nephew is part of the audit team that's auditing your business, that is not allowed. The reason why is because we have independence declarations that we need to sign at the beginning of any audit engagement. And if we are in contravention of that, it amounts to a violation of our ethics code. If we're not independent, I could have my CASA removed and never given back to me because I lied on my independence declaration. And the board has, our board, which is the IRBA, Independent Regulatory Board, has a way of finding that out. IRBA sends through their own auditors, very highly qualified auditors, to come through and audit the auditor. We get audited by IRBA. So they'll come and look at our audit files that we have for your estate agency, and they'll say, but the partner is related to the owner of the business. That's not allowed. You're going to give me back your CASA, and we are withdrawing this audit opinion. somebody needs to go back and audit this company. You've paid 20,000 Rand audit fees, it's done, and now they're coming back to audit you because they've revoked the opinion. Nobody wants that. The reason why the auditor needs to be independent is so that they can make clear and concise decisions regarding the audit, free of conflict of interest, okay? So if you decide to take your auditor to play a round of golf or for a wine tasting in Stellenbosch, trust me, it's not going to sway the audit opinion whatsoever, okay? They're going to remain independent completely, even if you buy them a gift, a beautiful box of wine or whatever, it's not going to sway the opinion because that's what they're trained to do. When an audit is performed, it is the financial auditor, which is also a name that you can call them, financial auditor, internal auditor, independent auditor, to make sure that the records are examined in an honest and forthright manner. How do you know? How do you have comfort in your heart knowing that we are doing it in an honest and forthright manner? It's because we spent 7 years studying how to become honest and forthright. Okay, we're quite experienced with this. We know how to be independent. Independent is quite a big concept in my world. You have to be independent in your state of mind, independent in your heart, independent in your appearance. There's a whole lot of things, but we're equipped to do that, okay? Now, can a review be performed instead of an audit? The answer is no, okay? What is a review and what is an audit? So if the auditor comes to you and says, but your business is small, we'll just perform a review rather than an audit, you say no because you need an audit report, you need an opinion, okay? You cannot have a review. It's illegal and it's not allowed in terms of the Act. A review is like a book review. You read something and you tell somebody exactly what happened in it. That's it. Sometimes they might ask you opinion, sometimes they may not, but if you read a book, you'll tell somebody exactly the synopsis of the book. That's the review. They're giving you a synopsis of what's going on in your business. They're not telling you, we think that everything's A-okay. They're just telling you what's happening in that business. But when you ask for an opinion, it's the auditors that need to say, we are of the opinion that everything is awesome in this business, or we are not of the opinion that everything is awesome in this business. That's the difference between a review and an opinion. So you need an opinion. And when must this audit happen? At this point, it's 4 months after year end. So if your year end is December, it's 4 months after December. So January, February, March, and the end of April will be your deadline. And if you fail to have your 4-month deadline, and if your audit takes 6 months or 8 months, okay, the FFC will not be awarded or it will be withdrawn. So please stick to the deadline. Now, what will the auditors need? Because somehow they find this one invoice or this one bank statement that was lost 10 years ago, and that's the one that they always ask for. So we apply something called risk assessment, materiality, and sampling. So, for example, if you sold 20,000 houses for the 2015 year end, and I wish that upon all of you, right? 20,000 houses for the first year. How do we select what we want to audit? Because we don't have 8 months, we don't have 6 months, we have 4 months to do this. Your audit timeline should not be 4 months. A well-prepared audit in this scenario should take 3 months and 2.5 weeks, or 3 months and 3 weeks. That last week of deadline should be the date that the report is being signed, the financials are being signed, and the audit opinion uploaded onto the auditor's portal on the website, okay? The reason why I say this, you have to account for things that you are not in control of. What if you leave the submission for 2 hours before the deadline? Load shedding, okay? Internet connection, now you've run out of data. Or something happens to the auditor's car and it breaks down. You cannot leave it to that last of a minute, okay? You have to plan for these things. Like I said, 3 months and 3 weeks is a good, absolutely great time for the audit of an estate agency, okay? Because it's not a state-owned entity, it's not completely complicated, okay? But it is possible in that time. So your auditor shouldn't be submitting this thing at the last hour. Because what happens to the website? Of course, it's natural for a website to have traffic. And then you can't get into the website and now you miss the deadline. So 3 months and 3 weeks, that's your timeline. Now, sufficient appropriate evidence. We know the definition of this. What I'm going to tell you is that It's a lot of stuff that we're going to be asking for, corroborating evidence, supporting documents. Like I said, sampling. If you sell 20,000 houses for the year, we're not going to audit all 20,000. We're going to apply professional judgment, which we've been taught to do. It's not just something that doesn't have a definition. Professional judgment, as well as risk assessment. So we're going to look at the risk that your business faces, the risk of the industry, the risk of your competitors, the risk of an estate agency being run by the estate agency board. Are there any loopholes? Are there any inherent risks? What are the business risks, okay? Is there any business risks that we need to be aware of? Is there any inherent risks, controlled risks? Is the person that's authorizing the check, paying the check, preparing the check, is there a safe lock that's on the door in the room that keeps all your documents? Control risks, things like that. All of those things. There's a huge list, maybe 20 pages long, that we're going to consider if they affect your business. And that's how we'll develop a risk factor. Okay, is your risk factor 1, is it 2, is it 3, etc. Now, or is it high, low, or medium? That's the usual thing. Is it a high risk? Is it a low risk or a medium? Let me tell you something. Estate agencies are usually between medium and high. It's just because of the industry. It's just because of the way your business is set up, okay? Don't be afraid. Then we look at something called materiality. Materiality is a limit, okay? If you had 20,000 transactions for the year, and at a minimum, the value of those transactions were R1 million, okay? Materiality comes in and says, do not audit transactions over 1 million. Or 500,000. Only look at transactions, only audit transactions above this limit. So everything below the materiality of 500,000 rand is not audited, but it is still looked at and it's still considered, okay? So in layman's terms, what does that mean? It means that we need a limit. We cannot test all 20,000 transactions. We'll test in detail a sample of all transactions over 20,000, sorry, over 500,000. But all transactions to the value below materiality of 500,000, we'll just have a breeze through and just look and see, is there anything that's kind of looking a bit dodgy, then we'll go and look at it, okay? So let's say, for example, 20,000 transactions, now we've narrowed it down to 5,000 transactions above materiality. We still can't audit 5,000 transactions. It's a lot of transactions. So what do? We apply professional judgment and we select a sample using materiality as well as the risk factors. So what are the different types of samples? How do we apply professional judgment? How do we just look at a list and say, which ones do we want to select? And trust me, it'll always be the one that you're least expecting. Okay, we look at transactions that are extremely high or extremely low. We look at transactions that with people that have the same surname as you. Transactions that are from people within the same address of your business. Transactions with surnames that we recognize or amounts that look really weird for a house that's just a 1-bedroom that's over R1 million. Stuff like that. We'll put our estate agency risk cap on and we'll select a sample like that. So there's a definition there for materiality. Materiality defines the threshold or cutoff point after which financial information becomes relevant. So it's the cutoff point until it becomes relevant. So we said 500,000. Now, the thing that I forgot to say, materiality is 2 things. It's quantitative, which is what we just discussed. It's a quantitative figure of 500,000. Okay, it's an amount, it's a figure, it's a mathematical amount. And then you get qualitative materiality. So what is qualitative materiality? So if your risk in the business is high, okay, that means there's probably a qualitative aspect. Why? Is the owner of the business going under debt counseling? Is there something that went off with a business partner? Those are all qualitative risks regarding the people that are working in this business, regarding the building that this business is susceptible to. When you live near the beach, you get rust and all of those things, stuff like that, qualitative issues, okay? So now, if that rust affects that file cabinet, you've lost documents, okay? Now, qualitatively, something is material. So we don't just need a figure, we look at qualitative aspects as well. Okay, and then what happens after that? We put together our information in an audit file. It's a software called Caseware, Teammate, Oracle. It just depends on what your auditor's using, okay? So ask them, what audit program are you using? And if they say no, nothing, you should get worried, because they should have an audit program, okay? They should have an audit program that collects the sufficient and the appropriate evidence. It should form a file, okay? Because the board could request this file at any point and have a look at your audit. So make sure that they're putting it together in a sufficient and appropriate method. It's very important. I cannot stress how important it is for you to have all your documents filed in either alphabetical or color-coded or area, or whatever, just filed in an appropriate manner. Filed in a way that you understand. It's not for the auditor. The filing system does not help the auditor. They just need the document. They don't care how you get it. They don't care if you look through 50,000 files for it. The filing system is for you, so that when they request something, it takes you 2 minutes to go and grab an invoice or go and grab a bank statement. You don't need to go through piles and piles of information. Okay, so my advice for you is to have a filing system that keeps all of your documents, whether it's a software or whether it's a folder on your laptop, on a hard drive. Make sure that it's backed up often. You know, files that are stored electronically can become corrupted or broken, so you can't even open them. Make sure that they're in PDF, etc., and dated and labeled accordingly. Okay. Like I said, debtors and creditors circularization. The auditor will always prefer and want independent information, independent verification. So we will trust you and say that this is your bank statements or this is your creditors amount or your debtors amount. But at some point, we are definitely going to contact the debtor, the creditor, the bank, the lawyers, the investment houses for confirmations, okay? So if the auditor comes to you and says, what are your lawyer's details? And you're like, but I haven't done anything. Why do you need the lawyer's details? It doesn't matter if you haven't done anything. They still need to request from the attorney. Has this estate agency been in any legal debates, or has this estate agency had any legal court cases that are pending, etc.? And they'll say no, obviously, because you haven't had anything going on. Then the auditor trusts that, okay? So don't panic if they come and ask you for that, or they come and ask, they're not going to look at parking fines and things like that, right? It's just stuff that's going on with the business. They're going to request bank statements and bank confirmation. So they're going to go directly to the bank and they're going to say, what is the amount that's in this bank account? And they'll put the bank account number there. And they'll say, is there any issues or legal issues as to who this money belongs to, etc. And then the bank will clarify straight directly to the auditor, not through you. You won't even know when the process happens. You just need to give over the bank details. All right. So nothing to be scared of. There's nothing that auditors are going to pick up that you don't want them to find if it's there already, okay? Now, they're going to also request schedules such as fixed asset registers, creditors listings, debtors listings. So please don't buy a chair in your office and not put it on the fixed asset register, okay? Every fixed asset that you buy needs to be in something called a fixed asset register. It's just a register where depreciation is noted, where additions are noted, etc., okay? They're going to request shareholders agreement, memorandum of understanding, any special resolutions passed. If you're a sole proprietor, they're going to request your tax submissions, okay? They're going to request bank statements, you name it, okay? That's what the auditor is going to request at a minimum. All right. Also, internal controls. I'm sure most of you don't have a very complicated and complex internal control system at your offices, but at a minimum, you should have something called segregation of duties. So if you are not there, who's signing for things? If you are not there, who's your replacement for the duties that you perform? Also, you cannot be doing everything in the payment or in any of the business cycles. You know, you have a debtor cycle, a creditor cycle, an asset cycle. You cannot be doing everything. There has to be a segregation of duties. So if you are doing everything, just say, for example, you're paying someone. You prepare the check, you take it to the bank, and you also physically make the payment. You authorize the payment. You prepare the check. That's not segregation of duties, and it's not ideal internal controls, okay? You need to have somebody who checks and reviews your payment proposal, okay? Payment must be made by a clerk, But if it's a small business, it's understandable that you cannot have 500 people in a payments department for an estate agency, okay? It's a small number of people, but make sure that you have segregation of duties, get everybody involved so that the auditor sees that there's no fraud happening here, there's no breach in internal controls, everything is 100%. We spoke about a reportable irregularity earlier, okay? What does it mean for me as an auditor and an accountant, and then what does it mean to you? A reportable irregularity is what you see, it's the definitions on the slide, but it's something that the auditor identifies in a business in his capacity as an auditor. And it's with regards to my act, the act that governs me. The act that governs you is the EAAA Act. The act that governs me is the Auditing Profession Act. And this definition comes out of Section 45 of my act, and it reads as follows. It's defined as an unlawful act or omission committed by any person responsible for the management of the entity, which is yourselves, which is caused or likely to cause material financial loss to the entity or any partner, member, shareholder, or creditor, or investor in respect of his or her dealings with that entity, is fraudulent or amounts to theft, and represents material breach of fiduciary duty owed by such person to the entity. It's a very broad definition. It covers anything and everything. So in my experience of estate agencies as an auditor, I will already have circumstances in my mind that constitutes to a reportable irregularity, but it's not limiting, okay? If you don't have your SIP-C documents and you are conducting a company and carrying on with the company, that's a reportable irregularity. If you haven't done accurate tax submissions, that's a reportable. When I say accurate, I mean you haven't done it monthly or you haven't done it yearly. If you're a sole prop and you haven't done tax submissions, it's a reportable irregularity. Okay, so for an estate agency, this is a list but not limiting, right? Instances of reportable irregularities that the auditor could pick up. Trading without an FFC, not submitting your report to the board within 4 months, operating without a trust account, not balancing or doing a reconciliation monthly, not keeping separate trust and business accounts, not administrating the trust account to show, trust creditors ledger to show either a surplus or a deficit, which you need to show every month, not registering with FIC and not reporting transactions over 25,000 Rand. So, let's look at an example. You had somebody purchase something from you for 25,010 Rand. Okay, so it's 25,000 Rand, 0, 25010, 25,000 Rand and 10 Rand. So now, what happens? You fail to report this because it's like it's 25,000 Rand, but the auditor picks it up. It's 10 Rand over. It does not matter that it falls below the 500,000 Rand materiality. In terms of FIC and FICA, over 25,000 Rand is the materiality. Anything over and above that needs to be reported. So now what happens? The auditor picks it up. The first thing as an auditor's responsibility is not to tell you. The first thing that the auditor does is lodges an RI, or a reportable irregularity, with our board, which is IRBA, Independent Regulatory Board of Auditors, okay? So we tell our board. That's the first thing. We don't even come to your door and tell you, hey, you haven't done this. We don't do that. We report to our board. And the awesome thing is that our board is linked to your board. So if you go to the website and if I put down this issue, reportable irregularity, you haven't reported over 25, that notification triggers a notification on the estate agency board. So they are aware of it immediately, okay? The next thing I do after I do that is come to you with the formal document to say, this is what we have found. You've got 30 days to either sort it out, but how do you really sort it out? You can't, right? You fail to disclose that you conducted a transaction over 25,000 Rand. So now, you've got 30 days to either rectify this issue, like I said, not much you can rectify, or you can defend yourself and prepare a legal case and get a lawyer and all of those things, or represent yourself, okay? And then after those 30 days, the auditor comes back to you. They set up a meeting and they come back to you and they say, okay, this is the meeting. What do you propose? Have you resolved the issue? or do we need to take it further? So obviously it's not something that you can rectify when you non-comply, right? So you'll say, okay, auditor, we cannot do anything about it because it was an oversight on our part, and what's the next step forward? The next step forward is that we once again send a notification to our board after 30 days to say that the reportable irregularity is still carrying on, and we cannot really rectify it because the client failed to acknowledge the fact that this transaction was over 25,000 rand. Then IRBA steps in, and then your board steps in as well. So they send representatives, they might withdraw the FFC, or they might give you a fine. It just depends on what the issue is. But if it's over 25,000 rand, they'll probably take away your FFC. But if it's something that can be rectified and you have fixed, then the RI goes away. It's noted on your record, but it's also noted that you've resolved it. And then everybody moves on with the audit. So that's how the process works when we find a reportable irregularity. My advice, make sure it doesn't happen. Okay, make sure none of this happens so that it doesn't delay the audit. Now, what happens if we do find an RI? That's 30 days more of extra audit fee. Okay, nobody wants that. So you have to basically pay them for finding this thing at your business. That's how it works. Last but not least, preparing for an audit. Things to be mindful of. Commit to the audit deadline. Okay, the audit deadline is 4 months. Make sure that the partner communicates this to the staff on his audit team. Make sure that you communicate this to your staff. They need to be able to assist the auditors at any given time because it's 4 months. It's not a long time for an audit. Your staff has their daily work to do. The debtors and the creditors, clerks have their daily job to do. Now the auditor goes and disturbs them for an hour and their work gets backlogged, right? You need to work around this. Find a way so that the auditor does not go over time. Let the clerks know that they need to assist the auditors as soon as possible, okay? More time they spend waiting for stuff, the longer the audit's going to take. Make sure that all your information is filed systematically, so when they come and they request stuff from you, you've got them filed, neatly kept away. You don't need to dish through 2,000 documents just to find one invoice, okay? There's something called the engagement letter. The engagement letter is something that you sign before the audit begins. You engage with an auditor, you engage their services, okay? It has all the terms and conditions for the audit. So, it also states who's responsible for the financial statements. What is the auditor actually auditing? Are they auditing internal controls? Are they doing a review? Are they doing an audit opinion, etc.? Everything is in the engagement letter. Make sure you read it and understand absolutely everything. If there's any other terms and conditions that you want to include, for example, the final invoice for the audit fee will only be paid once the audit opinion is submitted on the portal within 4 months. You can put that in there, that you'll only pay them the last invoice. If they say they want to be paid 3 times, so once, 3 times at the end of every month, okay? You can say that at the 4th month's payment, you'll only pay them once you have proof that the audit report was submitted. You can put that in your engagement letter. And then, please keep both your trust and your business accounts separately. 2 separate accounting systems, okay? They cannot be the same thing. They cannot be in one book. They have to be separate. And then lastly, be nice to your auditors because they're wonderful people. Now, you've gotten your audit report. The audit's over, okay? And then they give you a document which is called the auditor opinion. You've paid them 20,000 or 50 or 100,000 rand for them to give you an opinion about your affairs. That's exactly what it is. That's why we get paid, right? So in this opinion, in this report, there's something called an opinion with different legal and auditing terms, and you have no idea what it means, okay? So what I'm going to do is, I'm going to show you what the different definitions are regarding that audit opinion and what it actually means. But before I do that, I want to explain something to you called material and pervasive. Remember we said materiality constitutes 2 types, qualitative and quantitative, right? So if something is material, it means it's over the threshold where something is relevant. And then there's something called pervasive. Now, pervasive means that something in the accounting records is affected. And if it's not pervasive, it means that it's just affecting 1 or 2 accounts maximum. The financial effects don't filter down to the rest of the financial statements. And if somebody is reading the financial statements, this material issue does not sway the decision of the user, okay? But if it is pervasive, it means that it's material, it's over the threshold where things are relevant, and it is not limited to one or two accounts. It filters down through the rest of the financial statements, affecting all the other accounts, and it sways the user's opinion. So if the board is reading your financial statements, and if something is pervasive, it will affect their opinion on whether you are a viable and a business that is a going concern. So if something is material but not pervasive, okay, and if your financial statements have been misstated, that means accounts have been accounted for incorrectly, you could get a qualified opinion. So it's just like a small little paragraph in your audit report that says everything is accounted for in accordance with IFRS, which is International Financial Reporting Standards, except for this one small thing. And then they move on to the rest of the opinion. But if it's material and pervasive, it filters down through the rest of the financial statements as a result of being materially misstated. That is an adverse opinion. An adverse opinion is the worst that could ever happen to your life, okay? It means that the auditors will say in the audit report that we as the auditors find that the financial statements do not fairly represent the company or the ongoings of what's happening in the company. That's the auditor saying that we don't give an opinion. We say that things are not okay in the business, and that's really bad. Okay, and then you get something called a limitation of scope, like we spoke earlier, where we are unable to obtain sufficient and appropriate evidence. The file cabinet burnt down, or it got rusted and all the documents got destroyed. Okay, that's a limitation of scope. But if it's just one invoice that affected a small sale of maybe 20,000 Rand, it's material, yes, but it's not pervasive. So it doesn't filter down through the rest of your financials. It won't sway the user, okay? But if it is a sale of 10 million Rand and you've lost all the documentation, that affects all your accounting records. And then we'll give you something that's called a disclaimer of opinion. A disclaimer means we as the auditors reserve the right to comment on your business. We don't want to comment. We don't have anything to say. You've got a disclaimer opinion, but you've had to pay your audit fee to get that disclaimer opinion. Nobody wants that, okay? Something that nobody wants. You don't want to pay your 20,000 Rand and then somebody, by the way, 20,000 Rand is just an air figure. I just made that up. I don't know how much the audit fee for an estate agency costs. Nobody wants a disclaimer. Ideally, we all want something that's called an unqualified opinion. Some people use the term unmodified. That means it's just the normal opinion, which is unqualified. That's the one that you all want to aim to get, okay? So when you send your financials when the auditor sends the audit report to the board is just praying and hoping that you have an unqualified report. That is the best thing you can have. And it actually counts for something, right? So say, for example, in 4 years from now, you've always had an unqualified, an amazing audit opinion. But 4 years from now, right, something happens and you are 2 weeks late with your audit report. They actually look to see what your history was as an estate agency. They do. They say, but this estate agency is a first-time offender. They're just late because there was a family emergency. Let's give them a break. Let's give them a chance. And they will. So it's very important for you to have a good reputation regarding your audit. The next slide is just for you to note. It's the different definitions of what the different opinions are. And now I'm going to show you what an actual audit report looks like. Okay, it should be somewhere at the back of your handouts. So when you engage with an auditor, you need to let them know that there is a standard report format and template that they need to abide by. If they decide to do their own thing, it's not allowed. The board specifically says that this is what your audit report should look like. If the auditors want to be fancy and they want to put their logo somewhere on the side, that's fine. But as long as it looks like this document, 99%, okay? If they want to add in a little logo, normally auditors like to do that. It's free marketing, I think. If they want to add in their logo, it's fine, but it needs to look like this and only like this. They can't change the font, they can't change the words, nothing, okay? So what I'm going to do is I'm going to show you what the different parts mean in layman's terms, and then I'm going to show you in detail the actual wording of the audit report. So this is what it looks like. The first part of the audit report covers that the auditor conducted the audit in terms of IFRS, which is the International Financial Reporting Standard. Like I said, if somebody takes your audit opinion or your financials and they're sitting in Scotland or Dubai, they'll make complete sense of it because it's the same standard that we all use across the world, all right? Section A of the audit report, okay, the board wants to know, has this estate agency maintained their accounts in terms of the EAA Act? All right, so as you'll see there, Section A wants to know, has this estate agency maintained separate business accounts? Have the separate business accounts being audited? Has the trust account been reconciled? All of those things need to be in Section A. Section B wants to know any further matters of non-compliance. The 25 and 10 Rand, 25,000 and 10 Rand transaction that you fail to report to FIC will come in here, all right? As well as any reportable irregularities and have you been in possession of an FFC, etc. And then Section C is for the auditor to actually extract information of any interest-bearing accounts and interest that you might have earned, and the auditor needs to put this in here. Actual extracts. When I say actual extracts, I mean the figures, the actual amounts retained by you, the amounts that you received, the amounts due to the board, the amounts due to the client, if any, okay? Now, this is the actual wording of the audit report. So the first one I showed you was just layman's terms. What does Section A mean? What does Section B mean? Now this is the exact and actual wording of every audit report that comes out of your business. It needs to have this wording, okay? As you can see, it's got your firm PIN number there. And then the most important part of your report, is it qualified or not? Is it an adverse or not? Is it a disclaimer or not? So this part is here in red. And the part that's highlighted in yellow, I don't think you have in color, but this is where it needs to say your opinion. And if the auditor says, no man, but it's an adverse opinion, we'd rather have it on the last page of the audit report rather than the first page, the board's going to contact you and tell you, what are you doing? Your report is not in the prescribed manner. They probably fine you or something like that. Try and have it in this manner. And then it's very important to note that this part also has responsibilities of you as a director or a business owner and responsibilities of the auditor. It's clear that the auditor was engaged to do X, Y, and Z, but the responsibility of the director or the business owner is to actually maintain the accounts. So the auditor doesn't do the accounting and the accountant doesn't do the auditor. That's what it's saying, okay? And as you'll see there, the auditor's responsibility is a huge paragraph, okay? It's very specific, because if something happened in your business that was out of our scope, it's sort of a way to limit liability as well for your auditor. So please note that auditor's responsibility is on the audit report. There's additional procedures here that are included. So the board wants to know what procedures and what testing did the auditor do to ensure that you were in compliance with the Estate Agency Affairs Act, okay? So did the auditor do this, this, and this? And then this is a list that the auditor needs to complete to say that we have done the following. And if the auditor says that there has been non-compliance, it will result in a disciplinary, and nobody wants that, okay? Same here, where there's been additional non-compliance with FICA and the FFC and all of those things. This table is for the auditor to list the instances of non-compliance, and a negative answer will result in disciplinary. So if the board sees that you failed to obtain an FFC and you were still acting as a business and an estate agency, that will fall in here, and then once the board receives your audit report from the auditor, they will start the disciplinary process as soon as they see that. They also want to know if there was a reportable irregularity, and because you're an awesome estate agency, there was none. So the auditor will say there no RIs were found. Then they want information to be extracted from your accounting records regarding the amount retained by you for the interest-bearing accounts. So the auditor needs to put in audited figures, figures that he has already verified are correct, actual figures. And then he needs to state the procedures that he did to verify that the amounts stated above are accurate, valid, and complete. Okay? And then, restriction of use and distribution of the report. Your report is not going to get to your competitors. It's not going to get to anybody. It's not even going to get to an auditor that is not your auditor. Okay? It's not going to, the PAs at the EAB are not even going to have access to these things. Not that there's anything against them. I'm just trying to point out that your stuff is completely held confidentially, okay? Information does not get out. Nobody is allowed to give out this report to anybody because it's a breach on their part, and you can actually sue somebody for giving your information away. So you can trust that your information will be kept safely. And I want you to note who signs this audit report. It's not you. It's the audit partner. Okay, it's a CASA, that means Chartered Accountant South Africa, and an RA. An RA is a registered auditor. When you become a chartered accountant, you are automatically a registered auditor. This document is not signed by you at all. So what responsibility do you have as a business owner to make sure that you even know what's going on in this report? I've given you the template. I've explained to you what needs to be in there. You know exactly how it needs to look. But then the auditor gets to do the fun part and actually submit it on the portal. Okay. The reason why I say that the audit deadline should for you be 3 months and 3 weeks is so the last week is the days that you have to actually sit with the auditor and go through this document and make sure that you understand what's going on in your business. Remember, it's their opinion, so you can't sway it in any way. It's the results that they have found. But it's important for you as a responsible business owner to understand what this report says about you. Make sure that it's correct, make sure that it's accurate before submission. Another awesome thing that you can do, you can set up a meeting for submission. Okay, you know the auditor needs to do it via the audited portal. Set up an hour with them. Make sure that they do it, look at it, you know, try and inspect what they're doing. When I say inspect, I mean inspection, like just check that they're doing the right thing, okay? As a business owner and for paying such an exorbitant audit fee, of course you're allowed to do that. So it's done in your presence and then they send you the confirmation as well. So you have peace in your heart, you can sleep at night. Everything's done. Now you've got your audit opinion, audit's done. You've watched the auditor submit with you, right? Or you've watched the auditor submit and you're happy, everything's done. But now, what happens if you have a disclaimer or an adverse or a qualified audit report? There has to be implications, okay? So what are the implications and how can you get them? So if you have a qualified adverse or disclaimer opinion, okay, somebody from the board are going to request your financials, your accounts. They want to see what happened. Why did you get an adverse or disclaimer, okay? The basis of opinion is actually audited further, so they want to see, was this opinion given fairly to the state agency? But if it amounts to contravention of any compliance or any of the sections in the Estate Agency Affairs Act, or FIC, okay? FIC is Financial Intelligence Center. It's now going to be escalated by the legal department at the board, because that is a serious offense. Okay, then the disciplinary process is started to see whether you actually have been non-compliant or whether you need to be set free from all the charges. And if you're found guilty, then the sanctions range from a fine of up to 25,000 Rand, or they withdraw your FFC for a period, or some other form of reprimanding. Now, specifically with the Estate Agency Affairs Act and FICA, right? So yes, those ones were for the different opinions, okay, regarding the qualified adverse or disclaimer opinion. But if those opinions rose from either a non-compliance with the Estate Agency Affairs Act or FICA, or an audit reportable irregularity, then further to that, this also happens, right? It's still escalated by the board, and then the disciplinary process is started, and then you appear before a disciplinary committee, and then the same sanctions as before apply. A fine, or they remove your FFC, or withdraw, and then a reprimand. Now, last topic, submission of the audit report. The audit report is due within 4 months of your year end. So trust me, this is a fail-safe way. Tell them your audit deadline is 3 months and 3 weeks. The last week is so that we take things slow, we submit on time, and I want to meet with you, review the audit report so I know what's going on there. I want to be comfortable with all the the facts that are stated in there about my company, and then you chill because your audit has been submitted and you take a nice holiday to Johannesburg. Then they say that they used to say that the IT3B is compulsory and should be submitted together with the audit report always. This was what they said in the past. That means before the 1st of June. Okay, but that's changed. I'm not going to read further. I want to show you the new pronouncement. But if you look at what's up on my slide, there's been a change regarding the IT3B. Okay? Lots of estate agencies have been complaining that there's a delay. The bank doesn't want to really give them an IT3B because they have no money in there, etc., etc. So now your auditor comes on board with this whole process, and it says that we hereby advise that it will be acceptable for the auditor to attach a covering letter in place of the IT3B certificate. If you can get an IT3B, that's great. So try to. But if you can't, okay, it will be acceptable for the auditor to attach a covering letter stating the following. The reasons why we could not obtain an IT3B. So the auditor will have to write there and say, the bank does not want to give us an IT3B because of X, Y, and Z. And it needs to be attached with the audit report. When they are submitting that document online, when they're uploading it online, the covering letter needs to go on top. So the covering letter needs to have the auditor's header, you know, like on a Word document, you put a header. It needs to look like the auditor's document and needs to be signed by the audit partner to say that we could not obtain the IT3B, and as auditors, here are the reasons why we cannot obtain the IT3B, and we're attaching it on top of the audit report and we're submitting online. The delays or difficulties in obtaining the IT3B from banks should not delay the submission of the audit report. So if the bank promises you an IT3B in 2 weeks, and you think you might miss your deadline, submit it with the covering letter. And when you get the IT3B, you can submit that. Okay, so don't try not to get it. If you can get it, that's great. But if you can't, it's not a train smash. You should not miss your 4-month deadline. The auditor is the person that's responsible for the submission online, so they need a username and a password. Like I said, as a business owner, as the person that's responsible for paying those audit fees, set up a meeting to make sure that they're actually putting it online and you're happy, and they send through the confirmation. The confirmation was forwarded to you. You have proof. Everything's done. You can pay the rest of the audit fee. The board no longer accepts emails or post services or faxes or hand delivers anymore because it's a transition of a process, okay? Everybody's getting technical and trying to make things work easier. So if you submit it in any of those methods like post or emails or hand delivering, somebody's gonna lose that, or it's not gonna end up where it's supposed to, or it could get lost in the post. So everything's becoming very modern these days, so we're using the website and an upload system, and the auditor is responsible for that. If your audit report is late, do you remember what I said earlier, why it's so important for you to have a good reputation regarding the audit process? Well, that's going to come into play now, right? So if you fail to comply within 4 months, what are the repercussions? What happens? You're disqualified from obtaining an FFC, and it invalidates the current one. So what happens now? You're late. Do you even submit it? Of course you do, even if it's late, okay? You still submit it through the portal. If it's 5 months, you still put it through, okay? And then what will happen? You email the audited financial statements to the Section 27 department. You get the information online. And you have to go to the police station and get an affidavit. And the affidavit needs to contain the following: the reasons why it was non-compliance. Either there was a death in the family, God forbid, or it was some family emergency. If you have proof, if you're having a baby, a birth certificate or a death certificate, something like that, any proof, attach it to the affidavit so they know you're not lying. That helps, okay? If you had to travel, or if there was load shedding, send through the load shedding schedule, something like that, okay? Attach proof is always good. History and experience of the estate agency within the industry. That is very important. So if you've never been late in the last 5 years, that's going to count in your favor. But if you've been late for the past 5 years, that's a problem, okay? Even if it's your first year as trying to be or being an estate agency, and you try to submit your audit report late, and you have no previous history, that's still okay. I think they'll give you a break because it's your first time, right? And reasons why it's considered to be in the interest of the justice for the estate agency to be issued with an FFC. Why should you be issued with an FFC? my previous history has been great. This is the first time I'm late, or it's my first time in an estate agency, and I've had good sales figures, and I need to be released of this situation, and I need to be given my FFC, something to that regard. If the audit opinion was unqualified, like I said, guess what? You just pay a super small fee, and you get on with your life as an estate agency. But if your audit opinion was adverse, disclaimer, or qualified, then that's further consideration, right? And then it goes to the disciplinary process.
Let me start by answering a very difficult question that Lee has left to me on the trust account, why you need to keep one. In terms of section 32.1, it requires every estate agent to keep a trust account. So first and foremost, it's a legal requirement in terms of the Estate Agents Affairs Act, the 1976 one. It's quite an old act. It's actually older than me. But we hope once it's repealed and estate agents feel strongly that there's no need to maintain a trust account, or there should be at least some exemptions in terms of maintaining trust accounts, then maybe it can be taken into account in the new act. My presentation is going to be very short. The slides that I have here are not part of the handouts that were given to you. We prepared them recently after the 2015 audit cycle. So we thought it ideal to give you feedback in terms of the numbers when we closed the 2015 audit report deadline on 30 June. So I'm going to give you some feedback on the numbers, on whether it was successful or not. But before I go to the statistics, I just want to give you a little bit of context or background to the detail that Leanta was giving you in terms of the audit requirements. I always get asked this question so often from the estate agents and from the auditors themselves to say, is the Estate Agents Affairs Board imposing new requirements in terms of audit? And my simple answer to that is no. Section 29B has always been there since 1976. What has changed over the years is the way EAB has placed the emphasis on the audit requirements. So in the past 2-3 years, more emphasis has been placed on the audit requirements, and the format of the audit report has changed. Most of the estate agents who have been in the industry for more than 5 years, I think you will remember the one-page audit report, right? Do you remember the one-page audit report? Yes, it was easy to complete. Estate agents loved it, auditors loved it as well. But from the Estate Agents Affairs Board, the one-page audit report didn't give us enough information. It didn't give us information in terms of compliance with the Estate Agents Affairs Act. It didn't give us enough information in terms of compliance with the Financial Intelligence Center Act. So we're not getting much information from that one-page report. So in 2011, we then approached the Independent Regulatory Board for Auditors. So those are the regulators of the auditors who are supposed to complete this audit report. We approached them with a view of revamping the one-page audit report. So they had to set up a task team that came up with this new audit report format. We call it a 7-page audit report. So you can see it was a big jump from 1 page to 7 pages. So initially, when we introduced it in 2012, we had a lot of problems from the estate agents themselves, who didn't understand the need for the audit of business accounting records. We also had problems from the auditors of estate agents themselves. They were having problems completing it, because previously they were not doing it. They were just auditing the trust account, complete that 1 page, and then submit. So it was a big change in terms of the requirements of the Estate Agents Affairs Board. But we were just implementing the provisions of the Act. So what we did, we then said we have to have some interventions to make people understand what they would call the new requirements, although they are not new requirements. So we had to start from the auditor side, and we also had to look at it from the estate agent side. That's why we had to make audit compliance one of the topics for the CPD events. Then from the auditor side, we're also engaging with their regulatory body, the IRBA, to come up with a guide to the audit of estate agents. They've got a lot of guides for various industries. They've got a guide to the audit of attorneys' trust accounts. They've got a guide to the audit of medical societies, for instance. So we also gonna come up with a guide to the audit of estate agents to assist the auditors understand the estate agents industry better. So most of the issues that Leantha mentioned in terms of reportable irregularities, auditors are also having problems understanding those ones, and most of those issues never come to the IRBA, and they also don't come to the Estate Agents Affairs Board. But we then said, for now, we need to have interventions so that they can understand the industry better. So initially, we came up with frequently asked questions, specifically targeted to auditors of estate agents. We communicated that to all the registered auditors, and we also placed it on the website of the IRBA so that auditors can at least have an idea of what the audit of an estate agent involves. So we came up with 20 frequently asked questions. But the ultimate aim is to come up with a full guide to the audit of estate agents. Then I want to move on to the challenges that we were experiencing before as the Estate Agents Affairs Board in regards to audit compliance. So last year, around the 30th of June, okay, before I go to the deadline, most of the estate agents that are on our database, I think 95% of them have got a February financial year end. 95% of them. So that makes their deadline for submissions of 30 June every year. So 30 June is like the busiest period in the audit compliance department in terms of audit reports, right? And then, as you might all know, on the 1st of July, we then open the renewal period, which runs from the 1st of July to the 31st of October every year. That's the renewal period. So the problems that we were having previously with regards to audit report submissions, we had various channels of submitting audit reports. So what would happen on the 1st of July when I come to the office every year, I will hesitate to open my email because once I open it, it would have over 7,000 incoming audit reports. At the same time, reception will be calling me. There are about 1,000 hand-delivered audit reports. Our mailing department will be calling me. We have received another 1,000 posted audit reports, and that's on the 1st of July. In addition to that, we have got a queue of estate agents waiting to renew their Fidelity Fund certificates on the 1st of July. And estate agents can write, can complain. So most of the emails that I would get from estate agents on the 1st of July, they will be written in capital letters, complaining, looking for their audit reports, and I'm also not sure whether they're submitted or not. So with those problems, it will take us maybe a month or two to clear our inbox, the hand-delivered reports, to make sure they're all on the system. And then you might find out at the end of the month or 2 months that the audit report was non-compliant, for instance. The auditor didn't complete it properly, or it was signed by a person masquerading as an auditor who was not an auditor. And imagine the anxiety that would cause by then phoning an estate agent and telling him or her that your audit report is not accepted 2 months after submission. So most of the complaints that we were receiving, they were understandable because our processes were taking long to communicate whether we have received the report, firstly. Maybe it will take 2 months to tell you that we have received your audit report. Secondly, we might reject some of the audit reports, and then it's 2 months or 3 months down the line. So it was causing problems in regards to estate agents and the auditors. So we had to come up with solutions. So we looked at the Estate Agents Affairs Act, Section 32.4 specifically. So Section 32.4, it says the auditor is the one who is supposed to submit the audit report. So previously, will get these audit reports even from estate agents themselves. They would email the audit report. So Section 32.4 places the responsibility of submissions on the external auditor. That's firstly. Secondly, it gives the Estate Agents Affairs Board discretion to determine the manner of submission and the format of the audit report. So we had to make use of that Section 32.4 to determine the manner of submission. So although the EAB Auditors Portal was introduced in February 2014, we had not enforced it fully. So it was just like one of the channels of submission of audit report. But then we had to change that in 2015. We then had to make a pronouncement in terms of Section 32.4 and make the EAB Auditors Portal the sole manner of submitting an audit report to the Estate Agents Affairs Board. So from the 1st of March, we said we're not going to accept emailed audit reports, posted audit reports, faxed audit reports, or hand-delivered audit reports. All audit reports have to be submitted on the EAB Auditors Portal. So the EAB Auditors Portal is linked to the Register of Auditors that is maintained by the IRBA. So if your auditor is not registered with an IRBA, they won't be able to register on the portal and they won't be able to submit an audit report. So we managed to get rid of one problem of fake auditors submitting audit reports. That problem was resolved. Secondly, we also looked at the paragraphs that were causing problems in terms of completing by auditors. So there were certain paragraphs that auditors were trying to avoid to complete. For instance, auditors wouldn't audit the annual financial statements. So the paragraph where you are supposed to select an audit opinion, they would complete it or they would delete it, rendering the whole audit report non-compliant. So we had to make some of the fields on the portal compulsory to make sure that once the audit report goes through all the stages on the portal, once it gets to us, then it is compliant. So we reduced the second problem of non-compliant audit reports. So audit reports that come through, we are 100% sure that they are compliant. But going forward, we're still doing some further enhancements on the EAB Auditors Portal. For next year, it will do what we call a preliminary verification. For some of you who have used the SARS e-filing system, you would know as soon as you submit your tax return, you would, the same second, get a letter telling you what additional documentation, for instance, that you might need to submit. So we have enhanced it further so that once you submit an audit report, if there is further documentation that the principal needs to submit, you will automatically get the letter immediately. The EAB Auditors Portal is fully integrated with our system. So the minute that the auditor submits the audit report on the portal, that same minute, that report is on our system. That same minute, the auditor gets an email confirmation of submission. That same minute, the principal gets an email confirmation of submission. That same minute, the principal can log in on the EAB Agents Portal and view that same audit report. Isn't it wonderful? So it's real time. So I no longer receive all those emails of complaints. Auditors are satisfied. They get their confirmation of submission immediately. So I just want to share with you some of the statistics in terms of the previous audit cycle. So since we made the pronouncement on the 1st of March 2015, we have received a total of 8,200 audit reports online on the system, of which 5,500 related to 2015, and the remainder, about 3,000, related to 2014 and 2013 audit reports. So we still have a lot of estate agents who were disqualified for non-submission of audit reports previously, who are still coming back and submitting those audit reports. So about 3,000 of them came through since the 1st of March 2015. So since this new format of audit report, this 7 page audit report, there's been a lot of consolidation that has been happening in the industry. Some principals who had 2, 3, or 4 firms have since deregistered the other ones, and then they will remain with one. Some principals found it difficult to comply with the audit requirements, then they abandoned their firms and then joined the other existing agencies. So we've got fewer estate agents enterprises, but almost the same number of estate agents. So there's been some consolidation, but at least the situation is stabilized. We are experiencing fewer deregistrations as a result of the audit requirements. When we introduced this auditors portal, the main query that I used to get from auditors and estate agents was, does your system have the capacity to handle these audit reports? So estate agents and auditors alike were having problems in terms of the capacity of the system, whether it will be able to handle the traffic. So at least I've got comfort in terms of the system. It can handle the numbers. So we never had problems of people failing to get through. The system can manage the numbers and can manage the traffic. I just want to share with you the levels of compliance with the audit requirements. When we introduced this new 7-page audit report in 2012, 2013, and when we started the disqualification process, in 2013, 59% of estate agents firms didn't submit their audit report on time. It's a big number. Imagine having to disqualify more than half of the industry. It was a big number. We had big problems. Estate agents didn't know about this 4-month deadline, and they had problems complying with the deadline. But I'm happy to report that the numbers have since gone up. So in 2014, 77% of estate agents firms managed to submit within the 4 months. And then in 2015, we are on 82%. So it's going up. We're targeting 100%. Although my finance department would fight with me because they want to get more revenue in terms of penalties and fines. So they don't want to increase the compliance. But from my side, I'm happy to have increased the compliance so that at least we get through the first hurdle, which is submission. So submission is just the first part of compliance. The second part of compliance is the content of the audit reports that Leanta was referring to. So my advice to you, just submit on time and forget about the content. Just make sure you submit within 4 months. That's the first hurdle that you need to pass so that you don't dig a deeper hole for yourself. I'm going to take you through some of the queries that we received from the auditors. The first query that we received related to firm PIN numbers. So in order to submit the auditor's report on the auditor's portal, you need to have a firm PIN number. So estate agents didn't know about these firm PIN numbers, the majority of them. And this query affected mainly those estate agents who operate as sole proprietors. Those ones had problems identifying the firm PIN number. So the firm PIN number, you find it on the firm FFC instead of the individual FFC. So for sole proprietors, in most cases, they only have the individual FFC, they don't have the firm FFC. So they were having problems locating this firm PIN number. But we know in the second year, like in 2016, most sole proprietors would know about the firm PIN number. If it's still a problem, we might even have to include it on the website. When auditors validate an estate agent's firm, we can even put a firm PIN number so that it doesn't delay the submission process. We also had a query in terms of delays in sending login details. So auditors would register, but then it would take time to get the password and the username come through on their email. And this mainly affected those auditors who were registering towards the deadline. So some were registering at 9 p.m. and we had already knocked off, and then their details were not coming through. But we had to take that into account when we accepted the audit reports. Then the third query that we received related to attaching documents. So on the auditor's portal, you are supposed to attach your IT3B or the letter from the auditor and an audit confirmation letter. So some auditors had problems attaching those documents, mainly because of the way they were naming the documents. So the document name included some special characters and they were not going through, but we managed to resolve them. Then this error, I was worried about it and I had sleepless nights about it, is the heavy load error, where the auditor logs in and then it gets an error of heavy load in terms of a lot of traffic. But we managed to get rid of the error completely. That's why we managed to receive a lot of audit reports during the last 3 days. Then I'm also happy to report that the portal was only down for a few hours on the 19th of June. So it didn't affect a lot of the auditors. What we then did, after the submission process, we then compiled a list of all the auditors who had used the portal. I think they totaled about 1,000 or so. We then sent out an evaluation forms. So we opened ourselves to criticism. You know, auditors always have got negative comments. They hardly give positive comments. So we then send an evaluation form to all auditors and say, can you give us feedback in terms of what you liked about the portal and areas that you require us to improve for 2016. And I'm going to read a few of the positive comments that we received from them. So this auditor said one of the benefits was not having to send the report by email, but uploading it directly to the EAB and immediate confirmation that the report has been submitted. So auditors liked this issue of an immediate confirmation. This auditor says it was simple to use compared to the old system. I don't know what they mean. It's the same audit report, but they say it was simple. This auditor says it was very convenient for submission. The other auditor says it was easy to log in and fill in the information and fill out the form. This other auditor also mentioned confirmation that it was received by the EAB. Then I love this one. It says, we have found the portal to be a fantastic move on the part of the EAB. It has eradicated issues previously encountered with tracking reports which had been sent out but not recorded by the EAB, which was our main objective. This auditor says it is user-friendly, and I can be rest assured that the audit report was submitted. This auditor says submission is quick and confirmation is received almost immediately. This is a good move to keep up with technology. Then this one says it saves time than to prepare a manual EAB auditor's report, scan it, and email it. So we're very happy with the comments that we received. We also received some negative comments, which we are also taking into account in terms of improving it going forward. Now, the major benefit to estate agents of this, my EAB auditor's portal is, once your audit report has been submitted, I can guarantee you can get your FFC renewed on the 1st of July. You can ask your auditor to submit it on 3rd June midnight, and you can come the following morning and get your FFC. You don't have to delay. You don't have to send emails following up your audit report. It's immediate. It happens instantly. I want to speak briefly about the disqualification and the regularization process. I think Leandra touched on it briefly. I just want to speak about disqualification. What does it mean, disqualification? So disqualification in terms of the Act, it means you're disqualified from obtaining your FFC. That's what it means. Disqualification means you cannot get your FFC, so you cannot operate as an estate agent. So there are 3 grounds for disqualification, 3 major grounds for disqualifications in terms of the Act. Section 27. One of them is failure to submit an audit report within the 4 months. It's automatic disqualification. So 30 June is the deadline. 1st of July, we disqualify those who have not submitted. That's why I was saying, just submit an audit report. Forget about the content. Submit the audit report within 4 months. You have jumped one of the hurdles. The second ground for disqualification is if you are found guilty by a disciplinary committee. Remember I said, don't worry about the content? I didn't mean that. You have to worry about the content, but worry about it later. What then happens is the content, if it's a contravention, you still need to be found guilty by a disciplinary committee for us not to issue an FFC. So whatever the auditor says in the audit report, from the EAB side, it's more like an allegation. We're not going to withhold your FFC because the auditor alleges that you contravened the act. You will still have a right to appear before a disciplinary committee and be found guilty. Even if you are found guilty, we don't have a right to withhold the FFC unless withdrawal of an FFC was the sanction. Because remember, there are 3 sanctions that you can get from the disciplinary committee. You can get a fine of 25,000, you can get a reprimand, or you can get a withdrawal of an FFC. So you should then worry about the contents if one of the sanctions is withdrawal of an FFC. So the second ground for disqualification is if you are found guilty by a disciplinary committee. And then the third one is if you fail to comply with the prescribed education and training requirements. And CPD is one of them. It's one of the prescribed education and training requirements. So it's another ground for disqualification. So what does disqualification mean? If, for example, on the 1st of July, we disqualify you because you didn't submit your audit report on 30 June, what it means is, firstly, you cannot renew and obtain your 2016 Fidelity Fund certificate. At the same time, your current Fidelity Fund certificate, the 2015 one, it also becomes null and void. So although we issue the Fidelity Fund certificate valid from the 1st of January to the 31st of December every year, it's issued subject to you not being disqualified at any point in time. So if you are disqualified because you didn't submit an audit report, even if you have got FFC in your possession, it becomes null and void. So I hope you agree with me when I say just submit and pass that hurdle. You don't want to be disqualified on the 1st of July. You're putting your commission at risk by getting disqualified. Not only that, when we disqualify, it affects the firm, it affects the principal, and it also affects all the employees operating as estate agents under you. So it's not a nice feeling at all. So I urge submission, and I hope next year we'll be able to report 100% compliance as well. So if you are disqualified, so what? What happens? You are no longer an estate agent. If you are disqualified, you are no longer an estate agent. You have to then, if you want to continue as an estate agent, you have to come back to the Estate Agents Affairs Board and show cause why we should allow you back. So there is a longer process in the Act of reinstating disqualified estate agents. So you have to make a special Section 27 application giving reasons why we can readmit you, why you didn't comply in the first place. And before that application will go through the full board of the EAB, as in the board members. So they will consider the application. The full board will consider the application, and then they will then make a decision on whether you should obtain your Fidelity Fund certificate or not. And as you might know, the board meets once every quarter. So before, it would take maybe 7 to 8 or 9 months to have your Fidelity Fund reinstated. So it's a long process, and you don't want to go through the pains of seeking reinstatement. So specifically with the audit requirements, the board then came up with a new way of reinstating those who would have been disqualified for submitting their audit report late. Remember I said according to the Act, your application was supposed to go through the full board, which would meet once and then decide on the application. But then the board then says, let's delegate that part to executive management. So the EAB board gave management powers to consider the affidavit, the reasons for the non-compliance, and then levy a penalty and then reinstate you. So that new Section 27 process only applies to disqualifications as a result of late submission of audit reports. So disqualification as a result of you being found guilty, or a disqualification as a result of you not meeting the prescribed education and training requirements remains the audit process, which can take 7 to 8 months. So we've got a shorter way of dealing with the audit reports disqualifications.